Hi, everyone. Welcome to the Power Hungry Podcast. I'm Robert Bryce. On this podcast, we talk about energy, power, innovation, and politics. And I'm pleased to welcome Jim Murchie. He is the CEO of Energy Income Partners. He is a longtime energy investor, and we were acquainted, now 15 or 20 years ago, recently reacquainted. Jim, welcome to the Power Hungry Podcast.
Thanks, Robert. Great to be here.
Now, I didn't warn you. I sometimes warn guests. Guests on the podcast introduce themselves. I've given your title. If you imagine you've arrived somewhere, you have 60 seconds to tell people who you are. You don't know any of them. Please introduce yourself.
So sure, Jim Murchie. So I am CEO and co-founder of a company called Energy Income Partners. We invest basically in the energy sector and infrastructure, what we call poles and wires, pipes and tanks. We run about $5.5 billion. Numerous different kinds of funds. Some are New York Stock Exchange listed, some aren't. And we've been doing that now for 20 years.
Well, we talked the other day and about this whole idea of owning poles, wires, pipes, and tanks. The energy sector, as we both know, a lot of people know, is volatile. So why is it better to own these kinds of hard assets than to drill for oil or to produce electricity? What attracts you to owning the infrastructure stuff or the big iron rather than the flowing the molecules? What attracted you to this part of the business?
Well, it's where the returns are for shareholders. So, I started my career at the old Standard Oil Company of Ohio in Cleveland when it was majority owned, but not completely owned by BP in 1982. And watched the process of capital destruction up close and personal. You and I first met at the John S. Harrell conference, years and years ago, where Art Smith, who owned that fine organization, had really the best energy conference of the year. And I would kind of say the same thing every year. The cyclical part of the oil and gas business is just lacking in capital discipline, and what you find is that capital discipline and earnings growth tend to occur more in companies that have predictable, smooth earnings and cash flows. This is just not true, and not just true in energy. It's true everywhere. I mean, if you observe earnings growth rates across companies, it's just harder for cyclical companies to grow because they're constantly fighting the cycle. So in the world of energy, which obviously is my expertise, given where I started my career, the best returns come from these natural and legal monopolies that are operating these really long pipelines and really long poles and wires. And for whether they're a natural or legal monopoly, their pricing structure tends to be sort of a cost plus structure, sort of like a defense contractor. But defense contractors aren't particularly capital intensive, and pipelines and poles and wires are. So really, at the end of the day, you get this stable return on equity, because that is how the tariffs are derived to begin with. Because if you think about it, you're building a pipeline for an oil company, they can build it themselves. So they know the economics, and they're not going to use your pipeline unless the economics are good. And so you essentially mimic the economics of an acceptable rate of return with your customer when he signs up for that pipeline with, say, 10 or 20-year contracts to backstop it. And so because the earnings are really a percentage of capital, rather than a percentage of sales, which is what all other businesses are, not just in energy, you have stable earnings. And if the capital base grows or you're buying back shares, then the earnings per share are stable and growing. And then that really provides, the stability provides two things. It provides for a higher payout ratio. So the payout ratio of our portfolio is roughly 65% of earnings. The S&P 500 is 30%. And, the payout ratio of cyclical companies is also comparably low because no one wants to cut their dividend. Your earnings are cycling all over the place. You have to have a lower payout ratio on average. So stable earnings leads to higher earnings growth, more predictable business models, and a higher yield. And so when you look at how you make money as an equity investor, it's pretty simple math. It's yield plus capital appreciation. And capital appreciation over the long term is driven by earnings, and dividend growth on a per share basis in the long term, and in the short term by changes in sentiment, which is measured by valuation, like PE. So So the formula is pretty simple, right? Total return is yield plus growth plus or minus change in valuation. And so as we tell our investors, we start with the answer and work backwards. And so when you're looking at those attributes, where are you going to get the good yield? Where are you going to get growth? Obviously, valuations change all the time, so you try to bias your portfolio towards the cheaper things, but that changes over time. And you look at that in the industry that me and my partners are experts in, and you say, well, that leads you to poles and wires and pipes and tanks.
Well, so I looked at some of the holdings in one of your mutual funds, which is traded on the New York Exchange. It's EIPIX. So you hold, in looking at that, you hold a lot of pipelines, Energy Transfer, Magellan. And I want you to follow up on this idea of the natural monopolies. What, for people who are not familiar, it's hard to build pipelines, right? So the companies that have these pipelines, you explain what you mean by a natural monopoly and why
Yep.
why there's value there.
So the whole concept of a natural monopoly was discovered in the late 1800s with the railroads in the United States, which financially and to some degree for the markets as a whole was a disaster. And a guy by the name of
what do you mean by that? Was it for the markets
they
as a
were
whole?
over levered and overbuilt. So between Pittsburgh and Cleveland, you probably needed one rail line, but you had three or four, and so you have these guys clobbering each other over the head, with four sets of tracks when really one or two would have done. And so, a guy named Charles Francis Adams, who was the grandson of John Quincy Adams, decided to make his career in railroads and was the head of the first railroad commission in Massachusetts. And he made this simple observation that in the rail industry, the lowest prices, the lowest costs are on the routes with the least competition. And it wasn't that competition isn't good and doesn't lead to better products at lower prices, but what makes natural monopolies different is that it is an unnecessary waste of capital to have three or four sets of rails going between two towns. So now come to the modern world and say, imagine if you had four sets of poles and wires running down every street in every neighborhood. It's a complete waste of society's resources. So you say, so what's the alternative? Well, the alternative is granting a monopoly, but limiting that company's ability to charge what they want. And so, again, I'll go back in history, and there's a famous speech given by a guy named Sam Insel, who was Thomas Edison's right-hand man, and he developed pretty much what became known as Commonwealth Edison, which is essentially the electric utility in the Chicago area. And he gave a famous speech in 1897 at the North American Electric Light Association, which is now known as the Edison Electric Institute. And he said, we're really better off if we want to grow our industry and electrify the country if we do it as a single franchise for a given footprint. And that will do two things. It'll eliminate the duplication of capital, but it will also lower the cost of financing. Because if those companies are granted a stable return, yes, we're not going to be able to make 20% returns. We're going to make 10. But the cost of financing, because those cash flows are predictable, both in terms of how much equity we have to issue and what interest we will pay on our debt, will be a benefit to society as a whole. And we're not going to get any farther along clobbering each other over the head and wasting all this capital and going bankrupt like the railroads did. And so that is the model really around the world. It's the model in China, it's the model in Europe, it's the model in the UK, and it really has been with us for 100 years. And so as an investor, you say, well, okay, where does this go wrong? It's like they've been given this monopoly. They have stable returns. How does it go wrong? And so again, you look through history, and history tells you that when you give someone an allowed rate of return, which in their mind starts sounding like guaranteed, okay, which is a really bad word, they start doing dumb stuff. They start putting too much leverage against those stable cash flows, or they start diversifying into other businesses thinking, well, most of my cash flows are stable. It's okay if I go over and start, I don't know, this energy trading desk, right? And then, what happens is that activity, initially gets them a higher valuation because it's accretive to earnings until people realize they're destroying the quality of their earnings. And ultimately, it's a self-defeating diversification or leveraging. And the utility
So when you're
industry has
saying this,
been
Jim,
through both of those.
what I'm hearing is Enron, right? That this was
Enron was one, yep.
the pipeline company. But I want to jump back. I'm sorry to interrupt, but to jump back
And
to
everybody who copied Enron, right? I mean, you wrote the book on Enron, and it's like it wasn't just them.
sure.
They were apparently in the early years so successful that if you were running a pipeline or power utility and you didn't have an energy trading desk, you were viewed as being sort of a Luddite.
Sure. Well, let me jump back to Insel because I'm pleased Insel is vilified by a lot of people, but he was really a great innovator. And that was one of his key insights. I didn't realize that speech went back to 1897, but he was famous for essentially saying, yes, grant us a monopoly and regulate us, right? Going to the state and saying, you regulate us and make sure and we'll make sure we reduce the price of electricity. And that's exactly what he did. He saw that his great insight was the bigger generators I can deploy, the more customers I can get, the cheaper I can provide power to everyone. And that was one of his, obviously his great innovations, and was often maligned in the history of the power business in America, but really was one of the greatest
Right.
Of all of the energy entrepreneurs in the first part of the 20th century.
Yeah. But this, look, history is full of ironies, right? And so it was his company that was the most guilty of creating these utility holding companies that were essentially pyramiding companies on top of companies. And so by the time you got to the late 1920s, you had 19 companies that controlled 92% of the electricity in the United States.
Right.
And you had for every dollar of assets, you only had 10 cents of equity. I mean, they were levered like the banking system is. And so what happened in 1929 was, when there was weakness in the market, it was really the utilities that created the downside volatility because they were so levered. And people didn't realize how levered they were because they didn't look through all those holding companies. So in the early 1930s, we got the Public Utility Holding Company Act,
Right.
which then said, look, you guys, first of all, we're going to undo all these pyramids.
Right.
2, lower the overall leverage. 3, you're going to go back to poles and wires, okay, which is what you're supposed to do. You're getting into real estate and all kinds of other stuff. And we're going to sort of, get you back to state regulation. As you mentioned, Sam Insel preferred state regulation because in Chicago, if he wasn't buying off the alderman, he wasn't going to get a franchise.
Right.
And so it's so funny when people, they're afraid of, you're afraid of government regulation until you realize the alternative. And state regulation was far more preferable to him than regulation from the Chicago alderman, which was extremely corrupt.
Right. Yeah, and just one last point on Insel. I've written about this, but when he was on the stump in 1931, when Roosevelt was campaigning for president, I mean, he would call out Insel, and specifically by name, right? So Insel became this symbol of corporate greed, and then, of course, the Public Utility Holding Company Act of 1935 and the Rural Electrification Act of 1936 fundamentally changed the shape of the electric grid here in the U.S. So, but in looking at your the mutual funds that you're running, just as I glancing at them this morning, EIPIX and EIPFX, I see a lot of pipelines. I didn't in just glancing at them, I didn't read the entire prospectus. I didn't see many electricity companies. Do you hold wires companies? If so, what are they? Tell me about that part of your investment.
Yeah, sure. So as a registered investment, I got to be really careful about talking about funds and individual stocks. So I'll speak in generalities, but
okay.
What you'll find is that our overall exposure to the sort of the electric sector has ranged in the last 15 years from sort of 20 to almost 50% of the portfolio. When you look at any manager's portfolio and you look at the top 10, you may only be looking at 40% of the portfolio. So companies that are only 1 or 2% positions don't get in that list, but they in fact could make up the bulk of the portfolio. So that very often happens with us. So we may have only a handful of pipeline companies that we really, really like, and they're larger positions, and we have a whole bunch of electric utilities that, and increasingly over the last 10 years, they became more homogenous. So for example, when we got our start, we didn't really have much in the way of exposure to the electric utilities. And the reason was that they were still dealing with the unregulated businesses that came about when we deregulated the power generation part of the business in the 1980s and 1990s. Enron said, look, I know this sounds scary, but it's an opportunity. And so they went after the opportunity by acquiring infrastructure assets and building an energy trading desk so they could trade around that volatility, right? So you have to have physical assets to deliver against an obligation, and you need a sort of a financial operation to be able to make the contracts, forward contracts, buying and selling contracts over the course of 5 years, and making sure that book is hedged. Of course, everybody copied them. We know what happened. But when we got our start in 2003, the energy conglomerates were spinning off their stable assets, the pipeline conglomerates, into MLPs and in the US, and pipeline income trusts in Canada. And there was some divestments in the power sector, but mostly as investors, what we had to do was wait for them to close their energy trading desks and to divest of their cyclical and merchant business, which was primarily at that point power generation with highly cyclical earnings. And remember, you go back to what I said at the top, those aren't the kind of earnings we want. And so when you go back over the last 15 years of our history, it is the cleaning up of the corporate entities where, at deregulation, as much as half of their assets were cyclical. And here we are today, all these years later, and you're finally getting to the point where the larger publicly traded utilities are mostly the poles and wires, stable earnings types of businesses. The only exception to that are the states that never deregulated. So like the southeastern states in the US. So for someone like, Georgia, Southern Company, or Georgia Power, or Florida Power, like all those guys. So they never deregulated they never put the legacy generation assets for those companies into the merchant market. They still get that allowed rate of return on those assets the same way they do on poles and wires and pipes and tanks. And so when you look at the US as a whole, about half the US's generation is still in that rate-based model, allowed rate of return. And the other half,
the integrated utilities, right?
The integrated utility model, and the other half
is the same that Insel and Edison had going back from the very beginning, right? Yeah. Well, let me ask about that. Has that, because when we met shortly after after the Enron debacle, and in writing that book, my first book, Pipe Dreams, I remember very clearly one of my interviews with a guy named Jim Walzell, and Walzell worked for Houston Pipeline Company, and he quit Enron shortly after Ken Lay took over. And Walzell said at that time, this is more than 20 years ago now, he said, I don't see how this deregulation is going to be good for the consumer. He said, I just look at this, and this was shortly after Texas had deregulated, and now we're looking at this and we're seeing this massive costs that are being laid on consumers because a lot of these utilities were left naked, especially after the Texas freeze, and prices are going up dramatically. So it's a long way to get to the question, has deregulation been good for the consumer?
Ultimately, it has. So here are the statistics, and I'm glad you brought this up, because this is, when you look at the deregulation of electric power generation, it is a great window into the challenge of something that most people would agree is critical infrastructure. And most people would agree that reliable infrastructure, whether it's your water or sewer or roads or bridges, whatever, is a public good, that the public in general is better off, just like we're better off if everybody is literate, which is why we fund public school. And so, when I was at Standard Oil of Ohio in the early 80s, and I was in the business development group running economics and everything, one of the things I was running economics on was making our own electricity, which we could do for 3 cents a kilowatt hour. We were the biggest electricity consumer in the state of Ohio, and we were paying 6 cents a kilowatt hour to the grid. When I go back and look at DOE data, the national average back then for industrial consumers was 5 cents. 5 to 6 cents, adjusted for inflation over the last 40 years, it's between 17 and 22 cents per kilowatt hour. Wholesale price of electricity today, 5 cents a kilowatt hour. So you're talking a 65 to 75% reduction in inflation adjusted wholesale prices of electricity. Now, that's hard to say that that's not good for the consumer. On the other hand, once you take those power generation assets out of the integrated utility, where that company, remember, in return for that monopoly, they've agreed to two things. One is limits on what they can earn, and the other is an obligation to serve.
Right.
Anyone who wants power gets it. There's no sign that says no shirt, no shoes, no service. Restaurants can do that. Utilities can't.
Right.
Once you deregulate and go out into the free market, it's like every other free market. It's like, okay, I make Cabbage Patch dolls. I make microwave ovens. When I'm sold out, I'm sold out. I don't have an obligation to go source microwave ovens for the public. And so what you have when you deregulate something is you have the efficiency that comes with competition, but you have now lost your link to public policy. And so what we've done is we've built all these kind of, quasi guardrail types of things to try to ensure reliability. But I was at a conference recently, and I ran into a guy who knows these regional transmission organizations, which is what we put in place once we deregulated, so that all this power generation could be coordinated, because they're kind of regional markets.
Sure.
And I asked him, I said, it's a simple question, and it's a very difficult one. Who or what entity is ultimately responsible for the reliability of the power grid? And he said, it's really two things. It's the state regulated utilities, and it's the regional transmission organizations. And he was actually, the person who was talking was actually instrumental in designing market structure for two of the largest ones in the country. So he knew what he was speaking about. But I said, but ultimately, those regional transmission organizations, they're not going to get the blame if the lights don't go on. It's really going to be the utilities. The exception might be Texas, because their regional transmission operation, which is called ERCOT, the Electric Reliability Council of Texas, happens to line up with the state of Texas. That's an exception. The others cross state lines mostly. And so, that is the challenge. How do we make the electric system reliable and still have that free market competition principle, which keeps the cost down? And I think anyone who thinks the answer to that is easy hasn't tried to solve the problem.
Well, yes, and that's just it, and that's what happened after the big freeze here in Texas was, well, who's responsible for reliability? And the answer is no one. There, we'll point at ERCOT, and ERCOT took a lot of hits, but it wasn't. Ultimately, we've still got a very complex market in which the buck doesn't stop anywhere, right? Oh, the market failed. Well, who made the market? Oh, a bunch of lawyers, and so, but who's responsible? Well, nobody really at the end of the day.
Which works for most industries over time. I mean, it's
most of the time
it's the worst system except for all the others.
Yeah, right. But in terms of the wires business, I'm more familiar with pipelines because they're more obvious in terms of I think they're just bigger. But can you name any companies that I can't off the top of my head? The wires companies that are pure play, whether they're in your portfolios or not. Are there publicly traded entities? I don't know of any. What are?
Oh, sure.
They?
It's all So it's, as I said, the most of the utilities now you'll find in the Philadelphia Utility Index are mostly poles and wires, and they have power generation in their rate base. And so it's at the end of the day, when you look today at the composition of earnings for the Philadelphia Utility Index, it is fundamentally different than it was 15 years ago, where it's poles and wires and, for the most part, power generation that is in their rate base.
So Encore would be one, then I guess would be a poles and wires company. I'm just thinking about here in Texas, right? That's their okay.
Yeah. And for your listeners, that's Encore with an O, not an E.
Sure.
But that's right. Encore is a pure transmission company. Eversource in New England, which is the merger of the old Connecticut Power and Light and Boston Edison, they don't have any power generation. They are pretty much a pure poles and wires company. So there's a few, and as if your listeners, Encore has now been acquired by another company called Sempra, which was a Southern California-based utility.
Yeah.
Yep.
Which owns San Diego Gas and Electric, which I just wrote about today. In fact, on Substack, they're seeking it was a 17 or 18% rate increase in California for next year-on-year increase. When this year the rates in California went up 15%. So
well, they're cost plus entities, right? I mean, it's a cost plus pricing formula. So again, that's what you get, right? You get an allowed rate of return on your equity, and then you add up all your other costs, your interest on debt, and your operating costs, and your fuel costs, and you pass them through.
Right.
And so, and that sets up as people say, I wrote a blog on LinkedIn just yesterday about, this issue of moral hazard. And so you know, we as long-term investors, we worry about moral hazard creeping back in. We had it in the 1920s. We had it in the 1970s when the industry overbuilt nuclear power, which led to deregulation of the power generation part of the business. And moral hazard is a word that's in every article now about what's going on in the banking system. So I said, well, okay, I'm not an expert in banking, but let me give you a little historical perspective from the utility sector about moral hazard and how it's been dealt with in the past. But I
Yeah.
think it's a constant battle. And our firm and myself, whenever we talk to regulators and industry associations, we filed expert testimony with the Federal Energy Regulatory Commission. I testified in front of the Senate Energy Committee, as you did once. We argue that those allowed rates of return should vary with company performance on cost, reliability, safety, and emissions, and not just carbon, not just
Right.
methane, but
Right.
particulates, mercury, sulfur, nitrous oxides, things that are not healthy for people today, not,
Right. So
that
that's
may
interesting.
not have
So the
anything to do
state,
with global warming.
so the state should calibrate that allowable return based on performance metrics that are measurable and are ones that are impactful on society. Would that be a way to think about how you're approaching it?
Absolutely. They're kind of doing that anyway in the back and forth about whether or not they're going to allow a project. And Eversource got dinged by their Public Utility Commission in Connecticut because they were deemed to do a bad job in storm recovery when we had a bad storm. And anyone's been to Connecticut, it's a forest. There's trees everywhere falling down
Right.
on these wires. And so they took, they took like a 90 basis point hit out of their allowed rate of return. And it's like, well, how did you get that number? Why is that the right number and not 50 basis points or 150 basis points? And I think the way you introduce competition in poles and wires is, other than wasting capital and having four companies run four sets of poles and wires down your street, is to have this scale of performance, and you set up the incentives of competition without the waste of capital.
Yeah.
And I've talked to a lot of regulators about this, and they're like, yeah, so long as it's clear, because I don't want to be taken to court every time. The companies, the good ones are for it, the bad ones aren't. So industry associations, which represent the whole, because you think about it, once you go to that, half the companies will be below average and half companies will be above average.
Sure.
And an industry association represents everybody, so they're against it because half their members might end up in the bottom half. As investors, we think we're good at picking who's going to be in the top half. So
Right.
it's in our interest, but it's also in the interest of the public. And I think
Yeah.
ultimately it's in the interest of the utility industry, because if they don't evolve with all these new technologies that are coming out, I don't know which Chinese philosopher says it, if you don't bend, you break.
Hmm.
So I think it's time to modify the system that was put in place in the late 1890s by Sam Insel and bring it up to modern times.
Yeah, and this is the hard. I mean, this is the challenge, though, isn't it? Right? That this, what is enough regulation for these entities, and that calibrating that regulation so and make sure it's the right level of regulation. But let me shift
Which is why a score is so much better, right? Because once you agree to it, that's what it is. As a people, you just imagine a public utility rate hearing where you have business advocates, consumer advocates, environmental advocates, advocates for the poor. They're all there and they all have a voice, which is so great about our system. And they're all sort of shouting out their complaints about this or that. And it's like, well, okay, but those are all adjectives. We need to turn this into numbers, right?
Yeah.
I mean, you don't go to a restaurant and you say, geez, what do I owe you? And they say, you owe us a lot. It's like, no, you need to tell me the number.
Right.
And so I think that's hard to come up with a number. But I think once you do, then it makes it easier for the utilities to hit that number, and you provide the incentive, they'll do it. They'll figure it out way.
So yeah, I see. So you're saying we need a kind of a fair scoring system that would allow then this rate of return to
Yeah.
be calculated.
And they will argue till the
Yeah.
cows come home about what that scoring mechanism is. But you know what? Fine. Have the debate.
Right. So let's back up just a little bit. So you only invest in public companies, is that right? I'm
Yep.
not okay.
Yeah.
So
Private equity is a whole nother skill set. It's very labor intensive.
right. So well, let me ask you the direct question because I was looking up your, the two mutual funds that I found on your website, eipinvestments.com, EIPIX and EIPFX. You charge about a point and a half for your management. Um, why would I invest? Sell me here. Why would I invest with you and you charge me 1.5% a year, then put it in S&P 500? What do you do better? I mean, tell me, give me the opposite. If I was John Bogle, tell me why Bogle's wrong.
Yeah.
Bogle said get a index fund and put your money there. Don't trust these money managers. They're not
Right.
going to pick stocks better than the average. Why are
Right.
your returns better than the average, and are you worth a point and a half
Yeah.
a year?
Yeah. So so the management fee of that fund is actually less than that. You're looking at the expense ratio, but I agree with John Bogle. When people ask me, geez, you're in the business, what should I do with my money? The answer is, before they finish their sentence, out of my mouth is index it. So S&P has this research group, like SPIV. It's their research arm on a number of things, and they have done these studies over the year that shows that 90 to 95% of asset managers underperform the indexes. So when I talk to financial advisors, I say, look, I'm an active manager. The first question you should ask me is, are you in the 95% or are you in the 5%?
Aha.
And our history is that we're in the 5%. And so the question is, why is that? And I would say there's sort of, three things that make EIP different. One is, and it's not unique. We are a niche investor. We all come from the energy industry. Most of us have experience in the energy industry, so it's what we know, and we have figured out sort of where in the energy industry you can invest and beat not only the energy index but the S&P 500. And so that's the first thing that makes us different. But there's plenty of other niche managers out there. But as a percentage of assets run, they're very, very small. The second thing is that EIP was formed from inbound inquiries. People come to us and said, I know this is what you're doing with your own capital. Would you do it for us? And so when I meet a new group of investors, I always say, you have to understand the partners at EIP go to work every day to manage their own money. You're welcome to invest alongside of us. So, all these money managers, have this little phrase, we invest alongside our clients. We don't invest alongside our clients. They invest alongside us. If I want to invest alongside my clients, I would have money with them. I don't. They have money with us because we have this expertise. And you say, well, okay, so you have expertise, you're performance oriented, not asset gathering oriented, which is why, by the way, we have virtually no institutional money, because institutions carve the world up into categories and we don't fit any of their categories. And we've gotten numerous requests in the
So you're
past.
saying, so just to be clear, so you're saying you're not getting money from Fidelity or BlackRock or any of these big, those kinds of
Well, they're
people.
fund managers, so I'm thinking like pension funds,
Oh, okay.
endowments, things
Okay.
like
Fine.
that,
Okay.
right?
Fine. Yeah. So you
And so they
Tenco maybe.
people who
Yeah.
allocate to outside managers. And there
Right.
was a time, and it didn't last very long. There was a time when MLPs was a category, and they would look at us and they say, "Well, wait a minute, you got all this other stuff in your portfolio. I thought you were an MLP manager." I said, "I don't know who told you that. We're investing in non-cyclical energy infrastructure." And in the universe of non-cyclical energy infrastructure, MLPs never were more than 25% of that universe. And so they say, oh, well, we have an MLP mandate. I said, okay. I mean, we learned after a while, we used to like talk to these folks and have meetings with them. We learned early on that like in the first 60 seconds, you just cut off the conversation because otherwise you're wasting each other's time. And so we're performance oriented, not asset gathering oriented. And asset gathering money managers, they're out there lining up their strategies with categories because that's how you get money. If you don't line up with their categories, then they can't give you money. It has to be large cap value, small cap growth, right? The third thing is what I mentioned before. We start with the answer and work backwards. So the whole money management industry talks about alpha and beta. And it's like, okay, but that's really a backward-looking measure comparing a manager to an index. And it's to me, it's comical when hedge funds say, I'm an absolute return manager. We just generate alpha. Well, the irony of that comment is you can't calculate the alpha without comparing their performance to an index and calculating the beta.
So let me interrupt you because explain alpha and beta if you don't mind really quickly.
Yeah, so if you remember from, when you first learned algebra, y equals mx plus b, right? So you say the return of this fund can be explained by two factors. If the market goes up and down, the fund goes up and down, but not one to one. A high beta firm would go up more than the market. Market goes up 10%, a high beta portfolio would go up, say, 15, and the same on the way down. The question, you say, well, okay, that's in the up and the down. What about over many market cycles? You say, oh, well, actually, the market's made 9%. This fund has made 11. And so you say, oh, there's 2 percentage points of unexplained return. And so you say, well, that's alpha. Okay, that's fine. But if you're running money as opposed to allocating money to a manager, you say, well, how do I generate alpha? Well, since total return is yield, growth, change in valuation, unless your portfolio has some combination of higher yield, higher growth, and more improvement in valuation over whatever time you want to measure, you're not going to beat the index. And so when we look at our portfolio, we have this slide in our marketing deck. We compare the yield, the historic growth, and the valuation of our current portfolio with every sector in the S&P 500. So if our fund were a sector, it would have the highest yield, it would have the second highest growth behind technology, and it would have the second highest PE after financials, which are always low because they're so levered so much and risky. And so again, so if you don't have a higher yield and expectation of higher growth and, some opportunity to have a recovery in valuation, and even if you say, oh, the portfolio is fairly valued, you can say, well, okay, that means I'm not going to make money on valuation. I'll make money on the yield and the growth. And if those two numbers are higher than the S&P, well, then kind of by definition, over time, you'll outperform, and vice versa.
Gotcha.
And so those are the three things that make us different. We come from industry, we're niche. We are not asset gatherers, we're performance oriented, and we start with the answer and work backwards.
Got it.
I tell folks, I said, go to your money managers and ask them the following question. Of your historic performance and your expected returns in your current portfolio, break it down between yield, growth, change, and valuation. And I promise you, not a single manager would have those numbers at their fingertips.
Interesting. So let me shift gears here because we chatted the other day and I wanted to follow up on some of the things we talked about because oil and gas industry has been incredibly volatile, right? And it was the darling of 2022 and then we're in the first quarter of 2023 and these companies are just getting slaughtered. I mean, the drop in prices has been unbelievable. And we talked about this predilection among a lot of analysts to blame the Biden administration for high oil prices, and that the Biden administration has been, and I've thought some of these things myself. Oh, well, they're anti-oil and gas, and therefore the oil prices are higher because they're restricting investment and restricting drilling. You said no. You said, in fact, the other day that this is, I'm paraphrasing what you said, that it was complete BS. And that this was the discipline that's being imposed on the industry has nothing to do with the Biden administration, but rather, this is your word, that the shareholders have taken the credit card away. So what do you mean by that? I know in the shale revolution, this kind of a well-known number, $300 billion in capital was destroyed because all these CEOs, all these companies were just drilling because they could drill, and they drilled, and then $300 billion in equity and cash of investor money was just evaporated. But now you say the credit card is taken away, and that's the reason why we have lower levels of investment in the upstream. Is that, am I repeating what you've said correctly?
Yeah, exactly right. So, you say, well, what got the shareholders to do that? And, if you graph out the return on capital employed for the publicly traded companies, the large ones around the world, BP, including the Europeans and the Americans and that kind of thing. And they, like Saudi Aramco is public, but it's only public for a few years. We're talking, companies that have been around 30 years, and you graph out that return on capital employed, and it's dropped from about 10%. Granted, it's cyclical because it's a cyclical business, down to close to zero, recently. Obviously not last year because everything bounced back, but that trend
is really sort of, I guess it was kind of the frog in the hot water. Over 30 years, they kind of came down slowly and the frog didn't jump out of the water. But I think you correctly pointed out the shale revolution triggered this capital spending boom where, in a rare instance, the companies actually spent more than they made. So if you look, like one of the highest correlations as an analyst is the capital spending of the oil and gas industry versus trailing 12 cash flows. It's like a 95% correlation. But that correlation broke down during the shale revolution because they spent more than they made. Because what? Because investors are like, wait a minute, this is a structurally lower cost thing that you guys have figured out here. And while oil demand's only growing 1% a year, you guys are stealing share. So you can understand the investment thesis of why people would give them more money than they were currently generating for themselves. The trouble was the execution, and they got very sloppy. And when I was an analyst in Bernstein, I always say, look, companies do their best projects first and their worst projects last. So the more money they spend, the lower their average returns. It's tautological. And so when you see what happened with engine number one, who was the activist investor that went after Exxon, owning a sum total of 0.03% of their stock, and Exxon has 12 board members, and 4 of them come up for renewal, I guess, every 2 or 3 years. And engine number one went against management and won on 3 of the 4. And this sent shockwaves through the industry, where this tiny, and people said, oh, this was ESG and woke environmentalism. And it's not, because environmentalists divest of oil and gas companies. They don't own them. So the owners of Exxon that voted along with engine number one were tired of those low returns. And so that is why the industry is being so capital disciplined. And it actually, if you measure it, the way we measure it is kind of different than other people. You look at capital spending minus depreciation, depletion, and amortization. So now you have the net growth capital. And if you divide it by your capital base, you get the capital growth rate, which in the last 30 years has ranged between 2% and 12% during the shale boom, but since 2016 has been a negative number. And so from a historical perspective, the underspending in the industry today is historic. And so you say, so I think I wrote a LinkedIn post and I said, here we are coming up to, everyone's complaining about, the oil industry not spending enough money. Whose fault is it? Is it Biden's fault? Is it the environmental fault? And I said, no, it's mine. Blame me and all the other shareholders who have taken the credit card away. And
I'll follow up
on
on
that. It's not our
because
responsibility to make the system reliable. That's policy's responsibility.
Right. Well, so you say first question. So there's historic underinvestment. So is that, I know you're not necessarily tied to energy prices, but if we're underinvesting in the upstream, underinvesting in drilling, which I've heard many times in the last few months, does that mean that prices are going to be, is that a bullish indicator for oil and gas prices in the future?
Yeah, all else equal, it's bullish if you're not spending enough money. One of the things, the reason you got to subtract depreciation is because folks outside the oil industry don't appreciate that when you stop drilling, oil and gas production globally goes down between 6 and 8% a year. So if we stop drilling tomorrow and we had this meet and we met again in 365 days, you would see the world's production capacity would have declined by at least 6%. It's not like a factory where if you keep it staffed and keep it maintained, it cranks out widgets every day. These are natural reservoirs in the ground you're draining as fast as you can without damaging the reservoir rock. And so you need constant drilling. So we've seen studies that say, look, the industry needs to spend about $600 billion a year just to maintain production. So you say, okay, if the decline rate's 6%, that's about $100 billion per percentage point. So if you want to grow, because oil demand is still growing, the IEA just came out and said, 2023 is going to be the new high water mark for oil demand. Every percentage point you grow, you got to add $100 billion, and the industry's only spending about 450, 500. So the industry is way under where it needs to spend to maintain. You say, well, why aren't we running out? And you say, well, because you have a cushion, you have spare capacity, and that spare capacity cushion is narrowing.
So the engine number one thing that you just were talking about, I thought was interesting because I ran into a guy who works for engine number one in Dallas at the SMU conference. I was did moderated a discussion with Mark Nelson at that conference, and I happened to just sit next to the guy at lunch, and he said essentially the very same thing that you said, because the narrative about engine number one has been, oh yeah, it's these these leftist environmentalists, and this guy was like, no, I forgot whether he was at Goldman Sachs or somewhere else. He said, hell no. He said, this is about corporate governance. And we wanted
Yes.
to put people interested in shareholder return on the board. These were all board members that were all captive to Exxon, and they weren't really independent. And so, and
Yeah.
you know, from I haven't looked at it lately, but Exxon's price, the share price has recovered quite well, and it
Yep.
looks like engine number one is going to make a lot of money on the deal. But
Right.
the way that story was covered in the media does not match with how you've just been narrating it back.
Yeah. Yeah, that's right. I mean, I only have a voice when folks like you know, invite me on a podcast. But I mean, the Wall Street Journal would never publish an op-ed for me because, you know, I'm kind of right down the middle, and here's the mechanics, and it's boring, and people are asleep by the time I finish explaining it. So it's
Well, if only they knew how
that's
charming you are, I'm sure they would be
yeah.
awake.
But you can understand why the other stories make it to the papers because they you know they attract eyeballs and they're easy to read. So
So, but this underinvestment, though, you're saying is just simply a function of shareholders saying, no, damn it, we want our money back. It has nothing to do with
yeah,
these other issues around ESG, maybe, or is ESG playing a role here? I've heard, particularly for the coal market, that companies
yeah,
are seeing capital go away because of ESG. So, you're not, are you saying that
yeah.
that's not really the factor? It's more about the availability of capital from investors.
Yeah, it's overwhelmingly the shareholders, but the other stuff matters too. It's just it's tough to it's tough to you know identify you know percentages. But let's talk about coal for example. Before ESG became this popular investment trend, power companies you know have a choice. You know, do they make power from coal or you know or natural gas or nuclear renewable, et cetera. They have this whole and they for years now they have not started new coal plants. And the reason is that, you know, there has been pushback against coal plants for a long time. I mean, I've read stuff from the 1700s in England from country gentlemen who went to London and said it would take 2 weeks after they got back to their home in the countryside to recover, you know, from their sickness from breathing all that stuff.
Right.
Yeah, I recently ran into someone who moved to Indianapolis for the first time and came up and has asthma. He's never had asthma before. He goes to a doctor and he says, "Oh yeah, that happens." He says, "What do you mean this happens? People my age?" He says, "Yeah." He said, "What's the deal?" He says, "There's 5 coal plants within 100 miles of here."
Huh. Yeah,
And so
that's
it's
interesting.
still so you know whether it's mercury or nitrous oxide, sulfur dioxide, coal emissions, if they're unabated, are not pleasant to be downwind of. And that's been
Right.
true for hundreds of years. It's got nothing to do with ESG. And so when you think about a power company trying to, you know, get their allowed rate of return from a politically appointed entity called the Public Utility Commission, you know, putting up a plant that's going to create a people who come to your rate hearings objecting with you know somebody a picture of someone or someone who actually is suffering from emphysema, it's not going to go down well with the utility commission. And so people have, you know, the companies say, look, let's just not do that. Let's talk about the Keystone XL pipeline. um, TransCanada, which is the sponsor of that project, has a new CEO now, but their CEO for years was a guy named Russ Gerling, one of the best CEOs in the pipeline industry. And he's retired now, but every time we met with Russ, we'd say, cancel the project. And he says, well, no, the numbers are good. It's accretive earnings and this. I know what the spreadsheet says. I just don't think you're going to get it built, and I don't want it to be a distraction for you and our capital. We're, you know, it just I think this is a lightning rod for folks, and I think it's never going to get built. If you're an environmental group or an advocacy group or just a land use, you know, advocacy group, this is a lightning rod pipeline that allows them to raise donations. And so you're just fighting the wrong battle here. Just cancel the project. As a shareholder, I'm telling you to cancel it because I just don't think you're going to get it built. And I think it's going to cost me money. And so that's not ESG. That's just sort of the reality of what the public is going to let you do.
Well,
And
let's
so
talk
they didn't,
about that
you
because
know,
that's one of the other things we chatted about the other day, and it goes back to this discussion of natural monopolies and one of the issues that I've followed closely, which is land use conflicts. And I've been reporting on this now for years, which the wind companies don't like. And, they don't like me very much. That's okay. I'm okay with that. But we're seeing the same battles over solar. We're seeing the same battles over high voltage transmission lines. So one of the questions I wrote down here, there's a lot of talk. This is exactly what I wrote. A lot of talk about the need to build more high voltage transmission lines to accommodate renewables. Is that going to happen?
Yeah, I don't think it's going to happen. People talk about doubling the transmission system. You know, I'm 65. I'm really healthy. I'm not going to live to see that. And the reason is because of how hard it is to cite these things, and that's because of our governance and policy over the years. Remember, we're a confederation of states, and so like some other countries, in the world that grew up as a collection of local power centers that decided to get together and form a larger nation, those local power centers retained their sovereignty. And the idea that you can put in a policy at the federal level that's going to run roughshod over that simply ignores the legal and political structure that we all agreed to when we set this place up. The founding fathers set this place up to have different power centers that fight with each other all the time, not just three branches of government, but the difference between the federal and the states, the federalist system that we have. So I don't see that changing. And if there's
I don't either, Jim. I think that this is one of the great falsehoods that's being promoted. The line is there's no energy transition without transmission. But the idea that there is going to be some massive build out of high voltage transmission, it hasn't happened. There's no example that they can provide of a successful project that's been, that is more than a few hundred miles, and building it on an interstate basis is damn near impossible. And so
very hard. Very hard. So there's three pieces of energy infrastructure from a legal perspective. So oil pipelines are governed by the Commerce Department because originally they fell under the Interstate Commerce Act, which was for railroads, because before we had pipelines, we shipped oil by rail. Then we had natural gas pipelines, which is governed by the Natural Gas Act. I think it's 1928, and then we have the Federal Power Act. So of the three, interstate infrastructure, only natural gas has the right of eminent domain. So if you get a certificate from the Federal Energy Regulatory Commission approving a pipeline, that gives you the power of eminent domain. That is not true of oil pipelines, and it's not true of power lines. So within the state regulated utility has the right of eminent domain, but that's within the state. There's no crossing of state lines with a right of eminent domain to condemn for either an oil pipeline or a power transmission line. And
I didn't realize that was the case for oil. I knew it was the case for power lines. I didn't realize that was the truth for oil pipelines as well.
So within Texas, within the state, if you get a certificate from the Texas Railroad Commission, then that certificate comes with the right of eminent domain. And actually, on the Texas Railroad website, they say, we don't have the right to condemn your land. And it's kind of like, well, not directly, but as soon as you grant oil company, not A or oil company B that certificate, they have the right of eminent domain. So within the state, you see it, but interstate, no.
Well, so that goes to the heart of this issue of whether the ability to expand this critical infrastructure then relates directly back to those things that you just laid out there. That without that power of eminent domain for high voltage power lines or for oil pipelines, then I've put it this way: that the grid we have or the grids we have, whether it's oil and gas pipelines or power lines, that the grids we have are the grids we're going to have. Is that? I mean, that's how I see it. Do you think that's the same?
No, I think that's right. I mean, forecasting, something that's never happened before is always risky. As Yogi Berra said, making predictions is difficult, especially about the future.
Right.
But I will say though, I had a discussion recently with someone who's familiar with it's not an artificial intelligence company, but it's sort of a data analytics and failure prediction business. And what they found in analyzing some of these power transmission systems inside these utilities is that you have a few choke points that are massively, overused, but a large part of the remaining system is only 20 or 30% utilized.
Right.
So let's go back to that moral hazard I was talking about for utilities, where they're rewarded for putting steel on the ground. because we have this old regulatory system put in place at the turn of the 20th century, where we were still an emerging market trying to convince the world we'd be a reliable supplier of manufactured goods, like steel rebar and things like that. That incentivizes the putting on the ground of dumb steel, because the more expensive it is, the more the utility can grow their rate base and therefore their earnings. There isn't an incentive there to put in software, because software doesn't cost very much and it wouldn't add to the rate base. So if you change the regulatory structure so that it's value based as opposed to cost based, then what you'll see is the existing transmission system will end up probably having more capacity than people think it does. Doesn't mean you don't need new wire. I mean, you have a solar farm in some place, there's no wire, you have to string a wire to it.
Right.
But at the end of the day, the difficulty with wind and solar, even though they are now without subsidies, they are the cheapest form of new electricity. Get full cost economics on your project. So in the Sun Belt and in the Wind Belt, it's the cheapest electricity. It's intermittent, but again, that was not a requirement of our deregulated markets. But it's not energy dense.
Right.
And so the less energy dense your source of electricity, the more wires you need.
Right.
And so that's why when you look at the bipartisan infrastructure bill and you look at the IRA, what you see is a real shift in the types of energy that are being encouraged here. It really is an all of the above approach, much different than the last 15 years.
Yeah. Well, okay. And that's true, but is this positive?
Yeah, I think it is. Again, a lot of the questions we get from our financial advisors, because again, they're reading the papers. That's where they see this. Their clients read an article generally and ask them a question, and they come back to us. And the narrative around these things is always biased. It depends on whether you're reading the New York Times or the Wall Street Journal, if you're watching MSNBC or watching Fox News. And so each of those guys give like a partial truth, half truth. And what I like to explain to people is that, let's start with the result, which is the U.S. has the cleanest, lowest cost, most reliable energy system in the world. How did it get there? And it's like, I think it's because you have this constant debate between the federal policies and local interests. You have this constant battling between interest groups in Congress. And so some people will say, that's compromise or it's log rolling, and that's not what the policy was meant to do. It's like, look, all I'm telling you is I'm looking at the legislation, and the oil guys got their carbon sequestration tax credit increased. The nuclear guys got their production tax to keep existing nuclear power plants running, which is zero carbon. Okay, we've split the money now between renewable electricity and clean electricity. So you don't have to be renewable anymore. You don't have to be wind and solar to get this subsidy. You just have to be zero carbon. And there's zero carbon technologies out there, one of which is a natural gas turbine, that burns pure oxygen. And so the effluent is pure carbon dioxide. So it's simple to capture and it's economic. And so the result that you see, I think, is caused by this constant fighting that you're seeing on the news. It's like, I'm sorry that you had to see the sausage being made, but it's the best sausage in the world. So that's what it takes to make the best sausage in the world. It's this constant fighting and bickering. It's like listening to 5-year-olds, fight over a toy. But the result, you can't argue with the results.
Yeah, that's interesting. Well, I agree. The U.S. is incredibly well positioned now vis-a-vis the rest of the world, particularly when it comes to energy. So we've been talking about an hour now. So let me, I want to wrap because I know you have another engagement. Just a couple more things. What about, you mentioned nuclear and it got some favors in the IRA, and it did. Is it investable?
The way they've been doing it historically is not, where each project is not completely unique, but it's a new project. It's slightly different size, et cetera. And there's actually a lot of literature on this about sort of the problem with big projects.
Yeah.
Because when you go through the learning curve of that, the next big project is different and you can't apply what you've learned. You really need to make the same widget over and over and over again, which is why France's nuclear power program, plan, strategy, whatever. They built the same thing, just cookie cutter. They just,
Yeah.
if they wanted
Right.
a bigger plant, they put down 3 of the smaller ones.
Right.
In the US, it's like, well, that's inefficient. I have 3. I'm going to build you one that's one size. Well, in theory, that's true, but in practice, the execution favors the repeatability of smaller ones. So small modular reactors, when I've done a lot of reading on the one that'll be first to market, it's called, the company is, it's still, I think it came public through a SPAC or something.
New scale. Yeah.
And it's being done at the Idaho National Lab.
Yeah.
And I read actually a peer-reviewed paper scrubbing their cost estimates. And what's different about what they're doing is every piece of equipment that they're using exists for some other purpose.
Right.
So think MacGyver here, right?
Yeah.
You're taking paper clips and bubble gum, stuff that were made for something else, and you are making a nuclear power plant out of it so that you get the benefit of what's known as Wright's Law, where the more of a widget you make, the cheaper it becomes because your learning curve can be applied to the next one. So I think there's for me, having been an investor and seeing where things go wrong, when you look at what this company did, they addressed what the problems were. They analyzed history. They said, here's why it's bad. And we're going to come up with a new way without its conventional technology, just eliminating the mistakes of these basically site constructed. These things are so small, they're going to fit on the back of a truck.
Right. So last couple questions then, Jim, because we're right at an hour. Questions I always ask my guests. What are you reading? What books are on the top of your list?
Well, so I'm reading about 4 or 5 books at one time, but I'll tell you about the ones that I've finished recently that come to this is the whole environmental issue. I've read probably 10 books on global warming and things like that, and a bunch of peer-reviewed papers. But there's 2 I think your listeners would enjoy. One is written by a guy named Michael Schellenberger called Apocalypse Never.
Yeah.
Michael Schellenberger ran for governor. He's a 60s radical. And he's got some really great data in there about weather patterns and things like that, and just sort of like trying to calm down the climate alarms. He doesn't think, that spewing greenhouse gases into the atmosphere isn't a risk. He just wants for people to take a breath.
Yeah.
The other one is written by a guy named James Hansen, who ran the Goddard Space Center for 40 years. He's not a climate scientist anymore, but he was probably the most brilliant climate scientist in the world. And he's a great writer because he is describing to the reader sort of the difference between the greenhouse effect, which is why the Earth is warmer than the moon and cooler than Venus. It's our atmosphere and how it blocks infrared radiation back into space. He tells you what the feedback mechanisms are in the climate systems and how complex they are.
Yeah.
And that's the difference between the sort of the greenhouse effect, which is not in dispute, and the result of putting more and more greenhouse gas emissions in the atmosphere and its impact on the climate. And it's a fascinating sort of education on all these feedback loops, some of which mitigate the warming of the planet. Others, if they run out of control, are really frightening.
And I think, do you remember that title, Jim?
It's called Storms of Our Grandchildren by James Hansen, Hansen.
Yeah.
So I think those are great. I think they're easy reads, even though the one is a climate scientist, the other one isn't.
Right.
But they're really balanced, because people would say, "Oh, James Hansen, he thinks the world's going to melt," and Robert Schellenberger is like a '60s radical who doesn't think the world's going to melt quite yet.
Yeah.
And then
I've had Schellenberger on the podcast, but the Hansen book is interesting.
Yeah. The
so last thing then, so what, we've talked about a lot of things here, and we've covered this, a number of topics here for over, an hour. So there are a lot of challenges in the U.S. What gives you hope?
So, I'm an optimist. There's a story I tell. I was in Hong Kong once, and I met with Hong Kong Power and Light, which is one of the Li Ka-shing groups of company. Li Ka-shing is the wealthiest guy in Asia. He's pretty much responsible for Hong Kong's, business success. And Hong Kong is slowing, and so they started investing outside of Hong Kong. And I asked the guy, "What are your guidelines for investing outside of Hong Kong?" And he says, "Well, first I want regulated businesses with smooth capital." Okay, that's good. I'm there. He says, "The other is we only invest in English speaking countries with British common law." And I'm thinking, that's interesting. Why is that? And it's like, well, because if you study common law versus other legal systems, even civil law, it really is conducive to protecting contracts and protecting property. And so when I'm asked, people about, being optimistic, I say, look, be optimistic that you live in an English-speaking country with British common law, separated from the rest of the world by the world's two largest oceans, protected by the largest military in human history. That is something to be optimistic about. And you say, but it's, the politics is so bipolar and it's just so nasty. And it's like, read a little history. I'm not sure it's any more nasty now than it was in the 1800s or the 1900s.
Yeah.
And from my view, that nastiness prevents any one group from getting too much power, which is when you look at the history of the world, that's when things start heading south. So all of that bickering within this country separated from the rest of the world by these two oceans is actually, I think, the one thing that we should sort of continue to encourage. As soon as the debate is shut down, that's when we should start to worry.
Well, I think that's a good place to stop. My guest has been Jim Murchie, my old friend now from about 15, 20 years ago. He is the CEO of Energy Income Partners. You can find out more about him at eipinvestments.com. Jim, thanks for coming on the Power Hungry podcast. It's been a lot of fun.
Robert, it was great fun. Hope we can do it again.
Yeah. And all you out there in podcast land, tune in for the next episode of the Power Hungry podcast. Until then, see ya.